Okay, given that the time is now, I will start. Hello, everyone. I hope you're all in good health and spirits. On behalf of everyone at Investcorp, thank you for joining our conversation today. We hope that you will find this session informative, engaging, and timely. Today's discussion will focus on the U.S. economy, and specifically on the strength of the U.S. economy. And who better to discuss these topics than our Executive Chairman, Mohammed Alardhi, and Dr. Mohamed El-Erian, one of the world's top economists and most renowned global opinion leaders. Dr. Mohammed serves as Chief Economic Advisor at Allianz. He previously chaired President Obama's Global Development Council, was Deputy Director at the IMF, and President and CEO of Harvard Management Company. He's also a columnist for Bloomberg View and a contributing editor to the Financial Times. He currently serves on a range of prominent boards, including Barclays, Under Armour, the National Bureau of Economic Research, and we are privileged to have him as a member of Investcorp's International Advisory Board. Following the conversation, we will have a Q&A session for all the questions that have been sent in. You may continue to send them in on the email that was sent on the original invite. Now, without further ado, please allow me to turn it over to our Executive Chairman, Mohammed Alardhi.
Thank you, Jordana, and thank you everyone for joining us today from all around the globe for this special session focused on the world's largest economy, the United States. We thought of this idea and this talk a few months ago when we noticed during our ongoing communication with our investors an increasing number of questions regarding the US economy and its role in the world. These concerns were expected in the current climate with COVID-19, the social and racial justice movements, and the upcoming presidential election. And based on our global audience for this conversation, there continues to be much interest in this topic. Today, as Jordana said, we're honored to host one of the leading minds in the world and a great friend and partner to Investcorp for many years. Dr. Mohamed El-Erian needs no introduction. He's someone that heads of states and finance ministers listen to carefully for advice, whose TV interviews, op-eds, and comments are covered extensively by leading media outlets across the world. He has informed us all nearly at all our investor conferences through his sage wisdom and perfect analogies that put the most complex issues into easily relatable terms. In addition to his long list of titles, Mohammed has just moved to the UK to assume his role as president of Queen's College at Cambridge University, and I thank him for taking some time out of his extremely busy schedule to talk to us. Ladies and gentlemen, without further ado, Dr. Mohamed El-Erian.
Thank you, Mr. Executive Chairman, and thank you, Mohammed, my friend, for that wonderful introduction. It is such an honor and a pleasure to be with you, and thank you, everybody, for calling in. What I'm going to do is talk about the prospects for the U.S. economy. But rather than do it the traditional way, I will do it in a slightly different way, if I may. I will ask the question, what is it like if you're on the receiving end of what's going on in the US? And therefore, what does it mean for the marketplace? I'm going to do this while recognizing there's a very wide range of individual country circumstances. But the reality is that the US and China and Europe are so large that what happens to them matters a great deal as to what happens to the rest of the world. I call it the neighborhood house effect. As much as you care about your house, you also have to worry about the neighborhood. So I'm going to start from the neighborhood and then go down to the house and then go down to the room, which will be the implications for markets and for you. And I will touch both on economic and liquidity influences. So let me say a little bit about the neighborhood effects. I went to school in Britain, and I remember reading Charles Dickens' Great Expectations. And the opening to that speaks both to the economic and to the liquidity effects. In terms of the economic effects, think of the opening. It was the best of times, it was the worst of times. It was the age of wisdom, it was the age of foolishness. And then think of the liquidity effects. The opening paragraph goes on to say, it was the epoch of belief, it was the epoch of incredulity. It was the season of light, it was the season of darkness. I'm saying this because in the course of 2020 so far, whether you're an economy or whether you are the marketplace, you've gone on a roller coaster. For an economy, the global economy and the US economy has gone from a strong tailwind to a strong headwind. Global finance has gone from feast, famine, feast. And all this is playing into politics as well. It has encouraged a more inward-looking policy approach, not just in the US, but elsewhere. And it has disconnected economics from finance, Main Street from Wall Street, at a time when social justice issues, as the executive chairman said, have become day one issues. So why has the global economy been so important? I would say the following. The US and Europe have exported the following to the rest of the world. Lower demand, meaning lower trade, lower tourism, lower workers' remittances, and fluctuating commodity prices. That on a net basis is what the rest of the world has seen. And what of course it reflects is a historic downturn in global growth and world trade because of the lockdowns, and I'm going to come back to it. If you look at global growth as a whole, the best projection in my mind, and it's very difficult to project in this environment, comes from the IMF. The IMF is looking at a contraction of about 5% for the global economy. But the major, the really high numbers are in the advanced world, in the 8 to 12% contraction, and in Latin America. Asia, and China in particular, is on the other side. Hardly any contraction, or even, by the end of the year, an expansion. And the numbers we got today on retail sales in China shows you that both manufacturing and services are picking up. And the other parts of the world are somewhere in the middle of that range. So what does it mean? The US will not be a V-shaped recovery. It will not be a V-shaped recovery. The US will be what I call a square root. You come down very sharply, you then go up a little bit, and then you flatten too early. Part of that, and only part of that, is the health issue. And let me tell you, the health issue is complicated because of people's behavior. Not just the science, but people's behavior. We all are wired behaviorally to go back to where our comfort zone is. And our comfort zone is engaging. That's what we want to do. That is what we're wired to do. But engaging in a healthy fashion requires discipline. And what we're finding out is that that discipline is applied asymmetrically. Different generations, different people, different risk assessments. And the result of that is you and I face what's called counterparty human risk. We don't know enough about each other's health, and therefore we will engage less. This counterparty risk is not going to go away anytime soon. We need therapeutics, we need vaccines, we need herd immunity. We will not get all three until the middle to the end of next year. That's our reality. That's the first reason why we will not get a V recovery. The second reason has to do with policy response. We initially saw a massive policy response, what we call all in, whole of government, whatever it takes. And it worked. But the policy response was based on the mindset of the global financial crisis. You do it once, and then you're able to step back. It turns out that this is a multi-round policy response. And as we go further, political will becomes an issue. And you see this in the US, where the Democrats and the Republicans cannot agree on a fiscal package as they go forward. Then thirdly, the reason why this will be a V is because you've triggered anti-growth dynamics. Industrial concentration, the strong are getting stronger, the weak are getting weaker. Deglobalization are just two examples, as is household economic insecurity. So think of a square root. The recovery loses momentum, not a V-shaped recovery in the US. Same for Europe. China is the exception. How about liquidity? We have seen the correlation in liquidity go from +1 to -1. +1 was March, April, economic contraction, liquidity contraction, -1 has been since then. Doesn't matter what happens to the economy, liquidity, market functioning, and asset prices are just fine. Why? Because of massive central bank intervention. I cannot stress to you how far central banks have gone into market functioning. If you look, there's a very good Bloomberg article yesterday from Simon Kennedy that has the following quote. Global central banks are discovering that monetary policies they once viewed as unconventional and temporary are now proving conventional and long-lasting. The market is confident that central banks will not exit this policy regime. And if you're comfortable that someone with a printing press in the basement and infinite willingness to use it is going to be buying the market, you will buy the market too. And that is what we have seen with many more people entering the marketplace, including a completely new group of investors that are willing to take a lot more risk. So it's not surprising that we have seen this remarkable recovery in virtually every market you can think of. The question is what next? So let's look at the implication and what's ahead. Let's start with the typical economy, the good. Domestic policy reactions, the response of the IMF. They've dealt with over 100 requests. They've dispersed over 50 on those in record time. And because of that, we've avoided accidents for the most part. And to the extent that you had pre-existing conditions as a sovereign, Argentina, Ecuador, we had the first debt restructurings by Zoom, an amazing experience. Less good is that we're seeing less policy flexibility, higher debt, more flighty investor base, and of course, awful choices facing some developing countries, what to do with the economy when COVID is still high. A lot of people were surprised that India decided to reopen when its daily case number got to 90,000, a world record. Why did it reopen? Here's the calculus, and it's one that's going to be familiar to market participants. If you lock down, you know with a probability of 1 that you will deprive people from income. And that income, in turn, can cause significant tragedies, including starvation. If you reopen, you will get people sick, but it's not a probability of 1. It's a much lower probability. So faced with that choice, we are seeing governments that don't have the resilience of a New Zealand reopen, even though that curve has not flattened. So think of the global economy being on this bumpy journey to a more uncertain destination. What's going to be key is resilience, financial resilience. Which takes me to the last part. What does it mean for the average country, and what does it mean for investment strategies? The average country will see higher risk of policy mistakes and probably more volatile markets. And understanding the strengths and weaknesses of its component are going to be critical. For investors, be careful how you think about public markets. We're coming from very smooth sailing and a very large decoupling. Because of that, valuations in certain public markets are elevated. So you have to think dynamically about asset allocations, both within and among different public market segments. You also have to look for non-crowded opportunities. Granular analyses with laser-like focus on resilience and agility, including balance sheets, management, and payments culture are going to become important. You know, when my daughter writes me a nice note and ends with the word, "I love you," she spells love L-U-V. And that is really important for investors. We are going to see some L's, names that get hit hard in terms of prices and don't come back. We're going to see some U's, names that get hit hard, then you have a long time to position yourself and then they come back. And we're going to see some V's, names that come back quickly after falling quickly. Clearly, differentiating between L, U, and V based on the factors I've discussed is going to be key. It's going to mean very important active management, and it's going to mean very granular analysis. My own view is when we look back and say what portfolios benefit most from that, the portfolio will have concentrations in the US and Asia. It will continue to favor tech, and it will favor global real estate because ironically, global real estate's prices adjust really quickly and overshoot on the way down. Now, our colleagues in Investcorp are best placed to discuss these opportunities, but I'm happy to go into details on the Q&A. Which leads me to my conclusions. We are on a bumpy journey to an uncertain destination economically. Public markets are elevated valuation-wise and decoupled from the economy. Convergence will happen at some point. We just don't know at what point. Timing is almost impossible to get right. So what you need to be thinking about now as an investor is much more granular analysis that stress balance sheet resilience, cash flow, and management. Look for smart diversification and make sure that prices reflect what's ahead. Thank you for this wonderful opportunity, and I look forward to answering any questions you may have.
Mohammed, thank you. That's, like always, very stimulating and very insightful. I guess the first question I want to ask you, you were probably the only one at the beginning of this pandemic saying this is going to be serious, please take it seriously, please, you know, this is not like anything else we've done, it's going to shut economies. And a few months after that, and as the vaccines maybe hit the bazaar soon, how do you think we've done? as a global economy and as participants in this global economy?
So the reason, Mohammed, I was so cautious in January and the beginning of February and said this is different is because I had worked on Sudan in the 80s. And if you work on what was then a fragile country, or if you've worked in a region that unfortunately has been hit by a massive natural disaster, you learn two things. Economic sudden stops are very costly, and you cannot turn on an economy quickly. It's very different from a financial sudden stop. A financial sudden stop you can solve quickly. An economic sudden stop is very difficult to restore trust. So that's why I said this is very, very different. It will take time to recover from this. And I don't think people quite understood that it cascades. I use the example, a financial sudden stop is a heart attack. It hits you really hard, and you can die from it. But the doctors know what to do. You focus on the heart. And if you can get the heart going again, the body comes back. Economic lockdowns are not a heart attack. It's like having infections all over your body. And getting the pace and the sequence of infection control is much harder. So where are we? We have come back probably 30 to 40% of where we should have come back. And the reason why we're not where we should be is threesome. One is the science has been catching up, and the economics hasn't been talking to the science enough. Two is that the ability to change human behavior is very different. In China, you can control what people do. You really can control what people do. In the United States, becomes a political statement, right? So there's a massive range of how you can influence human behavior. And the third reason why we're not back to where we want to be is that we have inconsistent messaging. So if you go around the world and look at different places, you have different outcomes. I say this because in the United States, we ran a natural experiment. When we reopened, we reopened with federal guidelines and 3 different types of behaviors by states. There were certain states that said, I don't care about the federal guidelines, I'm going my way, I'm going faster. There are other states that have said, I'm going in line. So the first one, the example being parts of the southern United States, the second one being California, the third one was New York, saying I'm going much slower than that. So we ran a natural experiment in the US, and the result of that was very different outcomes. And the result of that was New York had to force a 2-week quarantine on people coming from 30 states. Think about that. So because we haven't had enough coordination within the US, and because we haven't had enough global coordination, our recovery has been less. So we are getting there, but until we deal with the basic issue of trust between human beings, it's going to take us longer than what it should.
My next question, Mohammed, is how resilient you would say the US economy is? I mean, many of our investors look at China and the US and say, China have done a great work on the healthcare issue and the pandemic. They're back growing. In the US, like you say, there's confusion about the pandemic. Wearing a mask is an issue. There are disturbances in the streets. What should give comfort to our investors that the United States economy is still their first choice?
It's Mohammed, ultimately the inherent strength of the economy and its institutions. So The Chinese model is going to be tested. The Chinese model basically says, I can leapfrog economic growth by turbocharging demand from the rest of the world. So China is in this very, very tricky transition of going from an external engine of growth to an internal engine of growth. So China is the first part of China recovery is easy, it's internal. Part is going to be external, and that's going to be much harder for China. The US is complete inverse. The US relies mostly on its domestic market and less on the global economy. And what the US has shown is that despite these pretty ugly developments in certain parts, that despite that, it can come back. And it can come back even if the global economy doesn't come back. And what you're seeing within that is some companies are doing great. I mean, literally, they're doing great. If you look at Microsoft, if you look at Amazon, if you look at Walmart, if you look at many companies, you'd be very hard pressed to pick up a pandemic. In fact, if anything, they've done better. Why? Because they can reorient themselves really, really quickly. So it's the structural positioning and the inherent dynamism of the economy. Now, I don't want to suggest that the US doesn't have issues. The US does have issues. It has to deal with inequality. There is a massive increase, not just in the inequality of income and wealth, but the inequality of opportunity. And that's what you're seeing in the street, is people are saying enough is enough. Not only have I not had past opportunity, but I'm worried about my future opportunity. If I may, Mohammed, I'll give you a number that really scared me. In March, when the school system in the Los Angeles area, the second largest school district, went into lockdown, the school lost touch with 30% of its students. 30% of its students they couldn't get hold of. And they tended to be students from weak or more vulnerable socioeconomic environments. They didn't have Wi-Fi. They didn't have computers. The kids may not have had their own room to do the lessons online. And one has to be very careful about this inequality of opportunity, because that's what makes people particularly angry.
Mohammed, one of the things that came with this pandemic is obviously all central banks and the Fed in particular is opening the purse, putting a lot of liquidity, making basically the market in many instances work. But when you look at countries in the emerging world, in the emerging markets, countries like the GCC, maybe India as well, and others, with not enough cash to keep throwing at this. What do you think, with all these vision plans that we have, say, in the GCC and the emerging market, what should leaders be thinking of post-COVID? How hard is it going to be to smaller economies that really needs a lot of work and a lot of focus and execution moving out of here?
That's a great question, and I would love to hear also your perspective. Let me tell you how I see it. Resilience is key. You and I have been close in discussions for the last few years. And one of the things that we always noticed is how many unthinkables had become reality. Way before the pandemic, who would have thought we would ever have negative interest rates? At one point, we had 30% of global government debt at negative interest rates. You lend your money to a government and you pay for the privilege of lending the money. There was no economic textbook that said this could happen. The United States was the champion of free trade. It became the most protectionist advanced economy. That surprised a lot of people. That was almost unthinkable. We had so many unthinkables that the system was signaling to us, the system itself was starting to signal to us that things had become unstable. Of course, no one predicted that we would have a pandemic, And that is the biggest unthinkable of all. But do you remember what we used to say in it is that the answer, whether you are a government, a household, or a company, the answer to pandemics, the answer to uncertainty is not paralysis. The answer is making sure that every single day you ask yourself, do I have these three things wired into my system? Do I have resilience? Am I able to take the hit and stay standing? Do I have optionality? Can I keep my mindset open and realize that a lot of what I thought before is changing? And finally, do I have agility? Can I move quickly when I see clarity? Resilience, optionality, and agility, the three things that we talked about at length in the last few years, is what differentiate countries, to answer your question. So the United States has massive resilience. It is the reserve currency. You have massive resilience when you have a reserve currency. If you're a small developing country, take a small developing country in Africa, you have virtually no resilience. And then countries go around that. The second is agility. If you're Singapore, you have massive agility. Okay, you've grown up having to adapt continuously to the outside world. If you're North Korea, you have zero agility. Right? Zero. And then the most important thing for leaders is the mindset, optionality. Be open to the fact that the world is different. Be open that you cannot make up your mind as easily as you made up your mind before, because you don't know. Which leads me with the last thing is behavioral science. We now know a lot about how you and I, the average human being, will react when faced with uncertainty. And there are three traps that everybody on this call should be aware of. Governments, households, and companies. Trap number one is denial. You simply refuse to acknowledge that we're in a different world. We are very good at denial as human beings. Trap number two is what's called reframing. You hear something, you see something, and you reframe it to something familiar. They did a great experiment, to give you an example, of taking 12 people, putting them in a hotel, and telling them, tomorrow, you have a flight leaving at 2 o'clock, and you have to get to the airport at 2 o'clock for the 2 o'clock flight. And then in the middle of the night, they called them. They woke them up and said, there has been a change. Your flight does not leave at 2 o'clock. Your flight will leave either at 8 a.m. or 8 p.m. And they hung up. And then they saw what most people did. And what most people did is they showed up for a 2 p.m. flight. Now, why does that happen? When they got the call, they heard that the flight could be either 8 a.m. or 8 p.m. They had the information. But when they internalized it, it was unfamiliar. What do you mean my flight can leave in the morning or the evening? No, that's not how flights work. Oh, maybe what I was told, it's the middle between 8 a.m. and 8 p.m. Oh, wait a minute, that middle between 8 a.m. and 8 p.m. is 2 p.m. 2 p.m., oh, that's what time my flight was going anyway, so that must be my flight. That's reframing. We do it all the time. The third element that's the danger is the worst. It's what's called active inertia. You know you have to do something different, and you do the same thing. So let me give you two examples. One, since I'm an American citizen, is one of my countrymen in Europe, in France. They go up to a French person and ask in English something. The French person either doesn't understand English or doesn't want to understand English. So they shrug their shoulder. The most likely response of my countrymen is the same thing in English, but louder. That's what they're going to do. Why? Because their mind is active. I have to do something different. Their inertia is to do the same thing, but louder. Companies suffer greatly from active inertia. IBM, on the eve of the PC revolution, was the best place to dominate that space. The single best brand and most trusted brand in technology. The biggest research and development budget, and lots of profits. Research by Don Sull at the London Business School showed that they identified the PC as a major disruption. They realized that part of the existing client base and many would go into the PC space. So they came up with the complete strategy. We are going to do less of what we do, the mainframe, in order to free up resources for the PC, and to pay for it and maintain our margins, we will take our mainframe higher up the value curve and charge premium pricing. This barbelled approach is the absolutely right response. The board approved it. 2 years later, IBM was almost bankrupt and got eaten alive by HP, by Compaq. Why? Because when it came to middle management wanted to continue doing what they had been doing in the past. So they couldn't move them. So even though top management was active, the inertia was inside. So when governments and when companies think about this world we're dealing with, they have to realize that there are behavioral traps that eat away at agility, that eat away at optionality. And it's very important to do that because it's not easy, Mohammed, unfortunately, to manage through an uncertain world. None of us like to be on a bumpy destination, on a bumpy journey, and none of us liking to be on a bumpy journey to an uncertain destination.
That's a very useful lesson for all of us, I think. I don't want to be greedy and take all the time. I will give the microphone to Jordana because I know there are many people who want to ask you questions. All to you, Jordana.
Okay, thank you very much. And thank you, Dr. Mohammed, for your thoughts. I will move to the Q&A part. I will try not to be repetitious on the questions already asked. We have received an abundance of questions and they're still coming through. So I've tried my best to group them and to tackle the most recurring themes. So the first question I'm going to ask you, Dr. Mohammed, is, can you explain the dollar loss in value and your expectations of where the dollar will be trading over the next 12 months?
That's a great question. The very simple way of thinking about the dollar loss in value is the following. One is that the Federal Reserve has become more stimulative than other central banks. So the interest rate differential that the US had has dropped. So if you were to do a comparison of US 10-year to German 10-year, at one point, that differential had gone to 280 basis points, 2.8%. It is now 110 basis points, 115 basis points. So the first one is simply because the US has been looser in terms of monetary policy, in terms of change, it has lost some of its interest rate advantage. The second has been the outperformance of the US markets. The outperformance of the US markets has been so pronounced that on valuation basis, people have started allocating to more. Still, US markets dominate, and for the right reason, but they're looking at other parts of the world. So the delta in terms of allocation has gone to the other part of the world. And then the third issue has been one of the standing of the dollar. There is talk that central banks in particular of some other countries around the world are worried about the fact that the US has weaponized trade policy and investment policy. That the US now uses sanctions to pursue non-economic and non-financial objectives. And when that happens, you diversify away from the dollar. So what has happened, as people know, is that the dollar index DXY has gone from 102 all the way down to almost 90, and now we're at about 91, 92. My own view is the bulk of the depreciation is behind us. So I understand it makes total sense that it happened, but I suspect that you will see that the Federal Reserve will become less different, and we're not going to see interest rate differentials move that much more from here.
Okay, so to link with that, and you've touched upon it in a few of your answers already, do you think that the US economy is still the most important diversified economy from an investor standpoint, or do you think there's a risk to that status in the long term?
So as I said earlier, that risk is a very long-term risk. It is very difficult to find, initial conditions matter, and you can't simply ignore initial conditions. And the US economy is by far the most dynamic, the most diversified, and importantly, it has the institutions. Institutions are really important. Now, that's not to say that the US institutions are not under pressure, they are, but relative to other institutions, they still dominate. So I think the US inherent strength is there. What a lot of us tell our friends in governments is don't take it for granted, because over the long term, it can erode. It doesn't happen very quickly, but if it continues to be under pressure, it can happen a little bit, it can happen quickly.
Okay, thank you. In the short to medium term, which asset classes will do best as we come out of this pandemic? If you were looking for free advice.
So let me tell you what you should look at, because they are very different asset classes. So look at the whole range. And I'll give you a perfect example. If I had been having this call with you 3 months ago, and I would have told you, you will double your money on Argentine sovereign bonds. Most people would have asked me, are you crazy? Argentina has just defaulted for the 7th time in 50 years. You're not going to do that. But the marketplace had overshot in terms of pricing. So you have a whole range of areas. You have distressed credit, where there are opportunities, because we are going to see a whole host of bankruptcies. And if you can be there, because most companies and most countries, and in fact all countries, emerge from bankruptcy, right? So there tends to be a asset price recovery. So distress opportunities are going to be there, but you really do need someone who knows what they're doing. The second element is what I call securitized credit. We are seeing that certain companies that have a lot of assets cannot get bank loans. Why? Because banks themselves are under pressure to control their credit risk. So a lot of companies, especially in some of the developing world, in Asia, are not getting access to credit as they should, but they have collateral. And if you can get securitized credit exposure, that is an advantage. Then you can go to tech, where I think there's still many opportunities that go well beyond big tech. That is a really exciting area. And you also have certain countries that are underinvested. Asia is an underinvested part of the world. So you can do that, but notice that I didn't say go and buy the S&P. Right? I said be very focused on granular analyses. And I think that you can put together a portfolio that will allow you to sleep at night and that gives you upside.
Okay, that links perfectly to the questions that's just come in. You mentioned US and Asia as the preferred areas to deploy capital. Can you elaborate on why you include Asia and which geographical or sector areas in particular?
So I include Asia simply because it's able to deal with the health economy nexus the best. If you see what Taiwan has done, if you see what China has done, if you see what Singapore has done, what you see what Korea has done, there is, if you see what Japan has done, there is a consistent message there, which is that people take collective responsibility very, very seriously. You know, normally we're responsible for our own health. Today, you and I are responsible for our own health and other people's health. Right? That's very different than in the past. The fact that my health, and then I go out and go into a store, and because this virus is airborne, the risk of infecting others is much higher. Now, the sense of collective responsibility is very strong in East Asia. And because of that, they're able to strike a much better balance between health and economy than the United States, being the other example, where individual responsibility way dominates collective responsibility. So you will see a much more pronounced recovery there than you will see in the rest of the world. And that's why I think Asia is important to look at. And especially so as other sources of capital are becoming more inwardly looking.
Okay. So with a similar theme, can you please discuss the implications of the ongoing decoupling between the US and China? And how do you expect this to impact investment opportunities in China and the US, and consequently the rest of the world?
So the decoupling process is not going away, but it's going to be gradual and it's going to be loud. There's a notion, for example, that this is all about President Trump. It's not. If you see what Vice President Biden put forward as his China policy last week, it looks very similar to President Trump. And that is because the view in the US is that China has abused the global system. The view in the US is that there was an implicit contract between China and the rest of the world, and in the US in particular. We allow you into the WTO. We embrace you, but you live up to your responsibility. And there's a view in the US that's very deeply embedded now that China has not lived up to its responsibility, to its global responsibility. And intellectual property rights are what is being held as the example. Now, the minute you start imposing tariffs and you weaponize tariffs, the use of tariffs expands. There's a reason why economists don't like tariffs and protectionism, because it's like letting a genie out of the bottle. It's easy to let them out of the bottle. It's very difficult to put them back into the bottle, okay? And the minute you start using tariffs for economic reasons, the national security people say, well, why don't we use tariffs for national security reasons? So the bottom line is these tensions are not going away. They're part of a gradual, multi-year deglobalization process. The most important question to ask, if you are another country, if you are Singapore, if you are Australia, is do I have to change how I approach both countries? Most countries use what I call a dual option model. Australia's security is completely interlinked with the United States. It is part of the Five Eyes intelligence network, massive intelligence sharing. And there is no doubt that Australia bets on the US for security issues. But Australia has also been betting on China for economic reasons. So you have a security option on the US, you have an economic option on China, and so far these two options haven't been contradictory. What countries worry about the most, Jordana, is that they're going to be asked to make a choice. choose this or that, which in option theory terms means the price of your options are becoming more and more expensive. And tech is the leading indicator. And if you look at the U-turn that the United Kingdom did on Huawei and 5G, it gives you a perfect example of that issue in play.
Thank you very much. Moving slightly, a question just come in from Saudi. How will real estate be impacted by the pandemic in the medium and long term? And how will the office sector be impacted, as well as big cities?
So for me, real estate is both an incredible opportunity and incredible risk. Okay, we are seeing today two major trends in real estate. First, commercial real estate has become more problematic. Why? Because a lot of what we do has gone virtual from physical, and it's not clear that it will all come back. And you see this in terms of what the retailers have faced, but you also see this in terms of Microsoft closing their stores and saying, you know what, we can do this virtually. We don't need physical presence. Now, if you owned commercial real estate, if you owned the mall, certain companies either have gone bankrupt on you or have decided they're not going to renew their lease. On the other side, there is what's happening in the residential real estate. A compound in the countryside has become much more attractive than an apartment in New York City. So if you look at what happens to the Hamptons, to Connecticut, versus what's happening to New York apartment, it tells you that people are now thinking differently about what living in a city is like. That's not going to change, go back like what it was. So in real estate, if you have people who know what they're doing, you have massive opportunities, because the price action tends to overshoot on the way up and tends to overshoot on the way down. So even certain commercial real estates today around the world are attractive because you've had an overreaction. And you've also had underreactions in certain other parts of especially, for example, in residential, because certain people don't adjust. If you're a seller, you don't adjust to the reality as fast as sometimes you want. If you're selling your house, you know how hard it is to realize that it's worth a lot less than what you thought. So I think global real estate is a really exciting area. But again, this is about active management. This is not areas that you go out and you buy an ETF or you just buy a REIT without knowing what's going on. You really need an active manager who has very granular analyses.
Thank you. So between COVID lockdown, Brexit, German elections, US anti-China pressure, what do you see as the biggest threats to the Eurozone in 2021?
So the biggest threat in the Eurozone is divergence. So if you think of it, okay, who would have ever thought that the Eurozone would worry about people's movement from one part to another? I'm not in the Eurozone, in fact, I'm in a country that's going to Brexit right now, but it has imposed quarantine requirements on people from France, people from Netherlands, people from Greece, and that just slows everything down. The Eurozone is not constructed for anything but the free movement of goods and people. That is what the Eurozone project is about: economic, social, and political integration. The coronavirus, because of the human counterparty risk that we talked about, means that this sort of integration is much harder. It's much, much harder economically and socially. And the question, the biggest risk is, to what extent does that reflect politically, right? And that's, I think, if you talk to certainly people in the European Commission, they are very aware of that. They will talk about the importance of solidarity even more now. Now, the reality is that means that the stronger countries are going to have to support the weaker countries. We saw a major breakthrough 2 months ago in terms of willingness of Germany in particular overcoming the hesitancy of the Netherlands to allow for more regional, what I call pooled insurance, that if you are one of the weaker economies, you can depend on insurance from one of the larger economies. Now, that's a small step, but it's a very important step.
Okay, question we have that's just come in from the UAE. Do you have a view about whether U.S. private equity will generally outperform U.S. listed equity in the post-pandemic world?
You know, that's an impossible question because there's so much diversity in private equity. What I would tell you is understand the two bets you're taking on private equity. One is a manager bet, which is that the manager who on your behalf will be leveraging your money. They are leveraging your money, okay? That's what private equity does. They leverage their money. Is going to be making levered bets on your behalf, okay? So you really do want to make sure you have the right manager. And the other one is what you want to make sure is there's an exit policy, that the manager will be able to exit their positions, which also has to do with the market issues. So that's the two things you've got to be careful of. But I find it impossible, unfortunately, to give you a general question, because if you're in the top 25% of real estate, you're doing great. Of private equity, you're doing great. If you're in the bottom 25%, it is really ugly, right? So you've really got to make sure that you've got it right in terms of manager selection.
Okay. This is another question from Saudi Arabia. Will the persistently low interest rates cause a change to classical portfolio asset allocation?
Yes, yes.
That's your short answer.
Yeah, I mean, the hardest thing to do today is to think that your bonds are going to protect you if something will go wrong. And I'm about to go through what everybody dreads, which you may hear my dog bark, and I apologize. But there's someone that's outside, so I'm sorry for that. But listen, in the old days, you could buy a US government bond or you can buy a European government bond, and you would know that the yield will come down a big deal if your risk assets get hit. And if your risk assets get hit, you have protection from your government bond. When interest rates are negative in Europe, that dynamic is not as strong. So yes, it does change the world in a significant way. Managing risk in today's marketplace has become much harder. And what you see sophisticated managers do is not go just for government bonds in the risk-free element, but go for a bundle approach in which they use several things, including gold, as part of your risk mitigation.
Okay, well, you then sort of answered the next question that's come in from the UK, is when you think about the relationship between risk and return, how has this relationship changed post-COVID? And if the environment is much more uncertain, meaning more risk, are investors being compensated more for the risk we are taking, or are investors forced to take higher risk for the same returns?
So, you know, there's a famous story of someone coming back home and saying to their spouse, look, I just bought a dog for $30,000. And the spouse looks at them and says, you did what? And the other one says, yes, it was a great deal. The cat was selling for $40,000 and I only paid the dog for $30,000. That is what's called a relative mindset. When central banks take the price of money to zero or negative, they make everything else look good. And what investors will do is they will get into a relative mindset. And you end up making a ton of money in that paradigm because everybody rushes to something else. So if you look, when central banks flooded the system with liquidity, you made money on everything. You made money on gold, even though gold is supposed to be a safe haven, and you've made money on equities. You've made money on everything. Why? Because everybody sees the alternative of cash and government bonds being so unattractive that they start buying everything you can buy. at some point, and that relates directly to the question, valuations become problematic in absolute terms. You are being, so yes, you are paying less for a dog than a cat, but you're paying too much for the dog. That's an absolute mindset. And what we are seeing in certain market segments is that you're not getting paid enough for the risk you're taking. And the biggest fear for public equities is that at some point, someone's going to wake up and say, I don't want to think in relative terms, I want to think in absolute terms. And what then you will have is a price adjustment. But as long as central banks encourage us all to think just in relative terms, then you will have this phenomenon that we have been seeing of basically everything going up at the same time. You've got to have a major capital impairment event, a bankruptcy, in order for you not to share in the upside.
Thank you. And I'm a little bit cautious of time, so this will be my last question before I then hand it over to our Executive Chairman for the closing remarks. So Dr. Mohammed, as you mentioned earlier, the pandemic has highlighted significant socioeconomic disparities across the globe. At the same time, we've been seeing trillions being poured into ESG-focused funds in Europe and in the US and the rest of the world. Can you talk a little bit about the ESG opportunity and how asset managers should be thinking about it? This came from Singapore.
That's a wonderful question, because whenever I do a discussion, we tend to forget about the silver linings of the pandemic. And I have felt so strongly about it that today I put out an article saying, here's my top 6 silver linings. Why don't you tell me what yours are? Okay, so what do I mean by silver linings? I mean that good things are happening. I'll give you an example. We are seeing leapfrogging going on in the medical world. Why? Because a lot of resources has been devoted to the vaccine development, the development of therapeutics. And when you do that, you get lots of side discoveries going on. We're seeing an incredible collaboration of scientists across the world. We are seeing pharmaceutical companies acting in a more holistic manner. We are seeing really good debates going on about the pricing and the distribution of drugs. These are good things. We're also seeing, and that's why I get to ESG, is awareness of what I call tail risks. Very low probability, high impact effects. A pandemic is a tail risk. You and I would not have even talked about the possibility of a pandemic in January. It was such a low risk, but when it happens, it's high impact. And now we're much more aware of other issues that are not even tail risks anymore, climate change being one of them. So what we are seeing is society is starting to embrace this notion of we have to think about tail risks more. We have to think about climate change more. We have to think about corporate responsibility more. Happening at exactly the same time that governments are talking about a green recovery, that part of the investments that we are pursuing should go into green activities. So it's very important to ask that question that was just asked, which is, do I have exposure to that part of that theme or not? Because that theme is not going to go away. It's going to be one of the silver linings of this awful and tragic crisis. And because this is the last question, I just want to say that it's always such a pleasure to interact and hear all these intelligent questions being asked. And I want to thank everybody. And just like I quote on the silver linings, don't also remember the risks that are still out there. So please stay safe. Thank you.
Dr. Mohammed, thank you. A very fruitful session, very insightful. I agree with you. You know, there are a lot of good opportunities and silver linings within this. The U.S. economy, with its resilience and dynamism, we have seen it at Investcorp for almost 40 years. It's a place where we were able to do business, compete, get rewarded, find opportunities, innovate in the way we do things. And we're really appreciative and honored to have you with us tonight. And ladies and gentlemen, thank you so much, and look forward to another session, hopefully as stimulating as this one. Thank you, sir.
Thank you. Bye.